Investment risk management framework. Let order students to join. Okay, let's start today's sessions. Investment risk management framework policies. Investment risk management. Investment risk management is a systematic process insurers, banks, and financial institutions to identify, measure, monitor, and control risk arising from investments activities. A well-defined investment risk management framework and policies ensures safety of funds, profitability, and regulatory compliances. An investment risk management framework IRMF is a structured system that organizations use to identify, assess, monitor, and mitigate risk associated with investments. It ensures that investment decisions align with the firm's risk appetite, regulatory requirements, and long term strategic goals. Meanings investment risk management framework formalized a set of policies, processes, and tools designed to manage risk in investment portfolios. It provides governance, accountability, and consistency in how risks are measured and controlled. The framework balances risk and returns, ensuring that investment generate value without exposing the organizations to unacceptable losses. Key components of an IRMF: risk governance. It clears roles and responsibilities. Board risk committee, portfolio managers defines risk appetite, how much risk the organization is willing to take. Policies approved the highest level of guide investment activities. How to mitigate risk identification, recognizing different type of investment risk, market risk, price fluctuations, interest rates, currency movements, credit risk, default by borrower or parties, liquidity risk, inability to sell assets quickly without loss, operational risk, process failures, fraud, technological issues, regular or legal risk, non-compliance with laws, risk assessment and measurement. First, quantitative tool, value at risk, VAR, stress testing, scenario analysis. Second, qualitative assessments, that is, expert judgment and industry analysis. Third, establishing thresholds and limits for exposures. Risk mitigation, diversification across asset classes, sectors, and geographies, hedging strategies, derivatives, insurance, strong due diligence before investment, setting stop loss limits, and exit strategies, monitoring and reporting, continuous tracking of portfolio performance and risk exposures, regular reporting to senior management and regulators, early warning system for emerging risk, review and improvements, periodic audits and reviews of the framework required to check all the possibilities, updating policies to reflect market changes, new regulations, or lessons learned, benefits of an IRMF, investment risk management framework, protects capital by minimizing losses. It improves decision making with structured risk analysis. It ensures compliance with regulatory standard. For example, SEBI in India, SEC in the US, builds investor confidence through transparency and accountability, supports long-term sustainability by aligning risk with strategy. Example in practice, a mutual fund in India uses an IRMF to set exposure limits to equity, debt, and derivatives. We have already discussed derivatives also we have discussed in our previous sessions. Stress tests are conducted to see how portfolio would perform under scenarios like interest rate hikes or currency depreciations. Risk reports are submitted to SEBI to demonstrate compliance and protest investors. Comparison of general risk management aspects given general risk management and investment risk management framework. Their scope in general management, all organizational risk, and in investment, risk specified to investment portfolios. Focus in general risk management, operations, legal strategies. In investment risk, the focus will be on market, credit, liquidity, portfolio risk. Tools in general risk management, policies, audits, controls, and in investment management, VAR, stress testing, diversification. Outcomes in general risk management, business continuity, and in investment risk, balanced risk return in investment. About stress testing, stress testing is a computer simulation technique used to test the resilience of institutions and investments portfolio against possible future financial situations. Such testing is customarily used by the financial industry to help gauge investment risk and the adequacy of assets, as well as to help evaluate internal processes and controls. In recent years, regulators have also required financial institutions to carry out stress tests to ensure their capital holding and other assets are adequate. Stress testing for risk management, companies that manage assets and investments commonly use stress testing to determine portfolio risk. Then set in place any hedging strategies necessary to mitigate against possible losses. Specifically, their portfolio managers use internal property Stress testing programs to evaluate how well the assets they manage might weather certain market occurrences and external events. Assets and liability matching stress tests are widely used to by companies that want to ensure they have the proper internal controls and procedures in place. Retirement and insurance portfolios are also frequently stress tested to ensure that cash flow, payout levels, and other measures as well aligned. What is back testing? Back testing is considered to be an important tool in financial traders' toolbox, without which they wouldn't even think of diving into the markets. Think about it before you buy anything. You would want to check the history of the brand, its features, etc., and check if it is worth your money. The same principle applies to trading, but what is backtesting? Even we are now available online rates of all products. So before to buy any product, consumer product, we always check rates on different websites, just like Amazon, Flipkart, Meesho, and others. Okay, means after we get the assurance that the price of this product is minimum in any specific website, who will take the decision to buy that product. In simple words, backtesting is trading test strategy, is the process of testing a trading hypothesis strategy on prior time periods instead of applying strategy for the time period forward to judge performance, which could take years. A trader can simulate his or her trading strategy or relevant past dates. An investment risk management framework is the it ensures risks are systematically managed, aligned with organizational goals, and compliant with regulations. Objective of investment risk management framework. Objective of an investment risk management framework are designed to ensure that investment activities are carried out in a disciplined, transparent, and sustainable way. The framework provides structure for balancing risk and return, protecting capital, and complying with regulatory standards. Here we have given few objectives that are protect capital, ensure liquidity, maximize risk adjusted returns, maintain solvency, reduce volatility, ensure regulatory compliance, align investments with business strategy, promote disciplined investment decisions. We will check first capital preservations of IRMF safeguard the organization's investors' capital against excessive losses, ensure that risk taking does not jeopardize long term financial stability. Example, setting stop loss limits to prevent large drawdowns in equity portfolios. Second, optimal risk return balance. Align investment decisions with the organization's risk appetite. It maximizes returns while keeping risk within acceptable boundaries, and use tools like value at risk VAR, stress testing, and scenario analysis to measure exposure. Three, regulatory compliances ensure adherence to law, regulations, and industry standards. For example, SEBI in India, SEC in US. Avoid fines, sanctions, or reputational damage for non-compliance. And these are fines in lakhs or in maybe in crores. Okay. So it must be avoided by the managing staff. Example, mutual fund complying with SEBI's exposure limits on derivatives. 4. Transparency and accountability. It provides clear governance structures with defined roles, board, risk committee, portfolio managers, etc. It ensures that risk management decisions are documented and auditable. It builds investor confidence through consistent reporting, diversification, and risk mitigation. Spread investment across asset classes, sectors, and geographies to reduce concentration risk. Use hedging strategies that are options, future, shop to protect against adverse market movement. We have also discussed about hedging systems in our previous sessions. Example, hedging currency risk for international investments, liquidity management, maintain sufficient liquidity to meet obligations and avoid forced asset sales, ensures that portfolios can withstand sudden market shock without collapsing. Example, holding a portions of assets in highly liquid instruments like government bonds. 7. Early risk detections. Establish monitoring systems to identify emerging risks before they escalate. Use real-time analytics and dashboards for portfolio tracking. Example, detecting credit deteriorations in bond holding before default occurs. 8. Business continuity and resilience. It ensures investment operations can continue during crises, financial downturns, geopolitical shock, builds contingency plans and stress test portfolio against extreme scenarios. For example, simulating portfolio performance during a global recession. 9. Performance measurement and improvement. It evaluates investment strategies not only on return but also on risk adjusted performance, continuously refine models, policies, and controls based on lessons learned. Means previous experiences must important to take the initiative about risk management. For example, comparing Sharpe ratios across portfolio to assess efficiency. 10. Stakeholder confidence. Strengthen trust among investors, regulators, and partners by demonstrating disciplined risk management. It provides regular, transparent reports on risk exposures and mitigation strategies. Why these objectives matters? Because financial protection, it prevents catastrophic losses, strategic alignments, it ensures investments support long-term goals, regulatory safety, it keeps the organization compliant and avoids penalties, reputations. It builds credibility with stakeholders, sustainability. It supports growth while managing volatility. The objective of an investment risk management framework are to protect capital, balance risk and return, ensures compliance, and build resilience while maintaining transparency and stakeholders' trust. Components of investment risk management framework. Components of an investment risk management framework are the building blocks that ensures risk in investment activities are systematically identified, measured, monitored, and mitigated. Together, they create a structured approach to balancing risk and return while maintaining compliance and stakeholder confidence. Here, few components are given. Risk governance structure. It includes board of directors, risk management committee, investment committee, chief risk officer, CRO, asset liability committee, AL, CO. Responsibilities define risk appetite, approve investment policies, monitor risk exposure, ensure compliance. First, governance and risk appetite. Board and senior management oversight, clear accountability for investment risk decisions. A risk appetite statement defines how much risk the organization is willing to take in pursuit of returns. Policies and procedures, formal documentation guiding investment activities. Second, risk identifications, recognizing all potential risks in investment portfolios. That's our market risk, price volatility, interest rate changes, currency fluctuations. Second, credit risk, counterparty defaults or credit downgrades. Third, liquidity risk, inability to sell assets quickly without loss. Fourth, operational risk, failures in processes, systems, or human error. Five, legal and regulatory risk, non-compliance with laws and rules. Six, reputational risk, damage to trust due to poor investment outcomes. Third framework is risk assessment and measurement, quantitative tools in which value at risk, stress testing, scenario analysis, sensitivity analysis are available. We find that few points coming again and again in all the risk management subjects and sessions. Qualitative tools, expert judgment, industry benchmarking, establishing limits and thresholds for exposures. Fourth framework is risk mitigations strategies, diversification, spreading investment across asset classes, sectors, and geographies, hedging, using derivatives, options, future swaps to offset risk, stop loss limits, automatic exit strategies to prevent large losses, due diligence through evaluation of investment before commitment, insurance, product liability, or investment related coverage where applicable. Fifth framework, monitoring and reporting, continuous monitoring, real time tracking of portfolio performance and risk exposures, early warning systems, alerts for emerging risk, reporting frameworks, regular updates to management board and regulators. Key risk indicators KRIs are metrics to measure risk levels against threshold. Six framework, compliance and regulatory oversight. It ensuring adherence to local and international regulations. For example, SEBI in India, SEC in US, Basel norms for bank. We have already studied about Basel norm, internal audits and external reviews to validate compliances, documentation of compliance, processes for transparency, technology and infrastructure, risk management systems, software or analytics, monitoring and reporting, data management, reliable, accurate, and secure data sources, automations, reducing human error in risk calculations and reporting, aid framework, reviews and continuous improvement, periodic audits, independent reviews of risk management practices, lessons learned, incorporating insights from past failures or near misses or our experiences which we found in our past tense. Frameworks updates, adapting to market changes, new regulations or emerging risk. Why these components matters? Governance ensures accountability, identification and assessment provides clarity on exposures, mitigations reduces vulnerability, monitoring and compliance maintains discipline and trust. Technology and review keeps the framework aligned and future ready. Its components are government and risk appetite and purpose define accountability and limits. For example, board approved risk policies, risk identifications, its spot potential threats, example, market credit, liquidity risk, risk assessment and measurements, quantify exposures, VAR, stress testing, risk mitigations, reduce impact, diversification hedging, monitoring and reporting, track and communicate, KRIs, dashboards, compliance and oversights, ensures legal adherence, SEBI and SEC rules, technology and infrastructure enable efficiency, risk analytics, software, review and improvement, keep framework updated, annual audits, the components of an investment risk management framework work together to create a disciplined, transparent, and resilient approach to managing investment risk. We have seen all these risk identification various investment risks such as market risk, credit risk, interest rate risk, liquidity risk, currency risk, concentration risk, operational risk, regulatory risk. First, market risk. The capital charge for market risk can be computed using the following approaches. Standardized methods, internal models approach. Standardized methods, that's a in the standardized method, market risk is computed for portfolios exposure to interest rate risk, equity risk, currency risk, and commodity risk using specific guidelines. The bank's total risk in the sum of this risk This method is simple but unsophisticated. Different underlying assets are equated without taking into account their differences in volatility. Since the risk charges are added, the effects of diversification are not taken into account. Internal model methods. In the internal model approach, banks can use their own risk management systems to be able to use their own models. Banks must meet the criteria laid down by regulators. The bank's risk models should incorporate a sufficient number of risk factors, a 10-day horizons, 99% confidence interval, and 1 year of historical data. That is 6 months if a non-equal waiting period is available. Since the risk charge are added, the effect of diversion are not taken into account. Internal model methods. In the internal model approach, banks can use their own risk management systems to be able to use their own models. Bank must meet the criteria laid down by regulators. The bank's risk model should incorporate the general market risk charge is set at the higher of the previous days VAR or the average VAR over the last 60 business days multiplied by a factor K. The floor for K is 3. A penalty components can be added to K if the variation of VR forecast reveals that the bank is systematically underestimating ri- its risk. After arriving at VAR, banks add the specific risk charge. This represents a buffer against idiosyncratic factors, including default and event risk related to individual bond and equity issues. To be able to use internal models, banks must satisfy qualitative requirement and have in place a rigorous back testing process. What are that rigorous process? We will discuss. The qualified standards include existence of independent risk control limits, a regular back testing programs, involvement of senior management and board members, integration of risk model with day-to-day management, a regulator stress test, compliance with documented set of policies, independent review of trading units and risk control unit. In addition, the model should incorporate a sufficient number of risk factors. For example, in case of material exposure to interest rates, there must be at least 6 factors for yield curve risk plus separate factors to model spread risk. Another is credit risk. This ability of structure finance to repackage risk and create safe assets from otherwise risky collateral led to a dramatic expansions in the issuance of structured securities, most of which were viewed by investors to be virtually free, risk-free or certified as such by the rating agencies. At the core of the recent financial market crisis has been the discovery that these securities are actually far riskier than originally advertised. Credit risk arises from the possibility of default by counterparty. Credit risk lay at the heart of the subprime crisis. The most important point to note about credit risk is that it is more difficult to model and measure compared to market risk. Unlike market risk, where a lot of data is available in the public domain, data is scanty and sometimes non-existent in case of credit risk. Moreover, credit risk is far more contextual, that is, firm specific compared to market risk. Despite these challenges, there has been significant process in credit risk modeling in recent years. In these sessions, we will examine the three building blocks of credit risk management: probability of defaults, exposure at default, and recovery rate. We will also discuss briefly some of the commonly used credit risk modeling techniques. These techniques can help us to estimate the potential loss in the portfolio of credit exposures over a given time horizon at a specified confidence level. The aim of this session is to provide a high level understanding of credit risk management. Pre-settlement and settlement risk. Credit risk can be defined as the likelihood of a counterparty failing to discharge its obligations. Any credit transactions typically involves two stages: pre-settlement and settlements. Pre-settlement risk refers to the probability of failure of the counterparty to discharge its obligations during the life of the transactions. This includes the possibility of defaulting on bond interest or principal repayment, or not making margin payments in case of derivative transactions. Since settlement risk arises at the time of maturity. Suppose a bank fulfills its obligations at the time of expiry of a contract. Till the time the bank receives its dues from the counterparty, settlement risk exists. A good example of such risk is foreign currency payments made by two parties in different time zones. In India, we use our Indian time system, Indian Standard Time, and we select in a computer also the four metropolitan cities, that are New Delhi, Calcutta, Chennai, and Bangalore. To deal with settlement risk, banks have developed the risk time gross settlement systems. Such system reduce the time interval between the point a stop payment instructions can no longer be made and the point of receipt of dues from the counterparty. Another technique used is netting. Instead of paying the gross amounts to each other, only the net amount is paid by one of the counterparties. This reduces the exposure and contains the damage even if things go wrong. Settlement risk arises as transaction involving exchange of value when UBS must honor its obligation to deliver without first being able to determine that the counter values has been received. In 2008, settlement risk on 78% of gross settlement volume was eliminated through risk mitigation. The most significant sources of settlement risk is foreign exchange transactions. UBS is a member of Continuous Linked Settlement CLS, a foreign exchange clearing house which allows transactions to be settled on a delivery versus payment basis. The proportion of UBS overall gross volume settled through CLS increased to 55% during 2008 compared to 53% in 2007. Means there is a rise of 2%. The avoidance of settlement risk through CLS and other means does not, of course, eliminate the credit risk on foreign exchange transition resulting from changes in exchange rates prior to settlement. Such counterparty risk on forward foreign exchange transaction is measured and controlled as part of overall credit risk on OTC derivatives. The probability of default. The probability of default is a key concern in credit risk management. Two kinds of factors must be evaluated to arrive at the probability of default: borrower specific and market specific. In borrower specific factors includes collateral, leverage, volatility of earnings, cash flows, and reputations. In market specific factors include the past of the business cycle, industry conditions, interest rates, exchange rates. Next is interest rate risk. Like any other global bank, HSBC is affected the market risk. HSBC separates exposures to market risk into trading and non-trading portfolios. Trading portfolios include those positions arising from market making property, positions taking, and other marketed to market options. Non-trading portfolios primarily arise from HSBC's retail and commercial banking assets and liabilities. Financial investment classified as available for sale and held to maturity. An independence unit within group risk develop the group's market risk management policies and measurement techniques. Each measures operating in entity as an independent market risk management and control function which is responsible for measuring market risk exposure in accordance with group policies and monitoring and reporting them on a daily basis. Inter interest rate risk arises principally from mismatches between the future yield on assets and their funding cost. As a result of interest rates changes, HSBC uses a range of tools to monitor and limit interest rate risk exposures. This includes the present value of a basis point movement in interest rate, VAR, stress testing, and sensitive analysis. With this, we can also study foreign exchange risk. HSBC controls foreign exchange risk within the trading portfolio by limiting the open exposure to individual currencies and on an aggregate basis. VAR and stress testing are also used to measure and control this kind of risk. Foreign exchange exposure also arise from net investment in subsidiaries, branches, or associated undertaking. The functional currencies of which are currencies other than the US dollar. HSBC aims to ensure that consolidated capital ratios and the capital ratios of individual banking subsidiaries are protected from the effect of changes in exchange rates. For each subsidiary bank, the ratio of structured exposure in a given currency to risk weighted assets denominated in that currency must broadly equal the capital ratio of the subsidiary in question. HSBC hedges structural foreign exchange exposures only in limited circumstances. Specific issuer risk, specific issuer credit spread risk arises from a change in the value of debt instruments due to a perceived change in the credit quality of the issuer or underlying assets beside VAR and stress testing. HSBC manages each exposures through the use of limits reference to the sensitivity of the present value of a basis point movement in credit spreads. Next is liquidity risk. The counterparty risk management policy group CRNPG was formed to strengthen risk management practices after the collapse of LTCM in 1998. The group recommended that financial institutions should apply an integrated framework to evaluate market, credit, and liquidity risk. Institution must stress test their market and credit exposures, taking into account concentration risk to counterparties and also the impact of liquidation of large positions on the markets. Many institutions started to integrate the credit and market risk functions after the LTCM crisis. That trend seems to have accelerated following the subprime crisis. Banks are realizing that liquidity risk must be integrated with market and credit risk. And as we saw a little earlier, even operational risk cannot be completely delinked from market and credit risk. The same argument applied to legal risk. Integrated risk management has the potential to create significant value of shareholders by treating their risk as a part of single portfolio. Organizations can have a better understanding of their risk situations. They do not need to take separate insurance cover against each type of risk. Transaction cost can be reduced if the hedging problem is viewed on a company-wide basis. Transaction cost can be reduced if the hedging problem is viewed on a company-wide basis. Efforts to limit one kind of risk often lead to an increased of another kind. The only way to prevent this is by taking an integrated holistic approach. Other is currency risk. Companies are no longer vying for the domestic market, rather, they want a part of a global share. While going global can help the company explore new market, it also gets with a new risk that is peculiar to international trade is currency risk. After the collapse of the Bretton Woods system, most of the countries moved towards market determined free float exchange rate systems. Under the system, the demand and supply for the currency in the international market determines the exchange rates. As the demand and supply for the currency keep varying, the exchange rate also keep fluctuating. While minor currency fluctuations are expected, it is the high volatility that could catch the companies off guard. There have been numerous instances of major currency volatility leading to depreciations of the currency. The Southeast Asian crisis led to a substantial decrease in the value of currencies of this region in a very short period of time. Even if there are no crises, the state of the economies which determine the investment flow also has a major say in determining the value of the currency. The recent consistent depreciation of the American dollar with respect to major currencies is putting the international traders in a spot of bother. Determinants of exchange rates. Before understanding exchange rate, it is important to know that it determines the exchange rate movements for nearly a decade. Now, the understanding is that price levels and the interest rates across different countries are the major determinants of exchange rates. Next is concentration risk. As we mentioned right at the start of these sessions, business cannot survive in the long run without taking risk. At the same time, the risk an organizations takes must be understood carefully and managed effectively. All global banks invest heavily in risk management models, but what distinguishes the successful bank from the other is the way risk manager is embedded in the fabric of the organizations. No organization symbolizes this better than Goldman Sachs. While many banks have been mauled and bruised by the subprime crisis, Goldman has actually thrived and made money so much so that it has become a target of attacks for many politicians in the US. The global bank Credit Suisse has developed a model for estimating default probability and value at risk. This model called credit risk plus is based on actual analytical techniques and does not use simulation. Credit risk modeled on the basis of sudden event. Default rates are treated as continuous random variables. Suppose there are n counterparties of a type and The probability of default by each counterparty is P if we consider that there are no only two possibilities, default or no default, and apply the binomial distribution. The mean number of defaults mean for the whole portfolio is NP. If P is small, the probability of N defaults is given by the position distributions. The next step is to specify the recovery rate for each exposure. Then the distribution of losses in the portfolio can be estimated. Credit risk plus allows only two outcomes, default and no default. In case of default, the loss is of a fixed size. The probability of default depending on credit risk rating, risk factors, and the sensitivity of the counterparty to the risk factors. Once the probability of default is computed for all the counterparties, the distribution of the total number of default in the portfolio can be obtained. When the probability of default is multiplied successively by exposure default and loss given defaults, we get the credit loss. Through the use of sector analysis, credit risk plus can measure the impact of concentration risk and the benefits which can be obtained through diversification. Credit matrix, another popular model, has been developed by JP Morgan. Unlike credit risk plus, this model does not view credit risk as a binary situation. Instead, credit matrix tries to determine the probability of a company moving from one rating category to another during a certain period of time. We have already discussed about operational risk and regulatory risk in our previous sessions. Risk measurement and assessments. Measuring risk using value at risk, duration analysis, sensitivity analysis, stress testing, scenarios analysis, credit rating analysis. Risk limits and controls. Setting limits for exposure by asset class, exposure by issuer, sector limits, maturity limits, country limits. Its controls, authorizations procedures, internal checks, compliance monitoring, risk mitigation techniques, diversification, hedging, asset liability matching, rebalancing portfolios, insurance or guarantees, monitoring and reporting, daily, weekly risk reports, key risk indicators, portfolio performance review, compliance reports, audit reviews, investment risk management policies. An investment policy statement is essential, the North Star for any investor, whether you are managing your own portfolio or working with an advisor. It's the formal document that outlines your financial goals and the specific strategies you will use to reach them. Investment policy statements. An investment policy statement defines investment objectives, risk appetite, assets allocation strategy, permissible instruments, risk limits, performance benchmarking. Asset allocation policy specifies percentage allocation to equity, debt, government, securities, risk, real estate, mutual funds, purpose, balance, risk, and return ensure diversification. Credit risk policy covers minimum credit rating for investments, exposure limits per issuer, approval process for lower related securities, monitoring of credit quality. Liquidity risk policy ensures sufficient liquid assets, cash flow forecasting, limits on liquidity, investments, emergency liquidity plans, market risk policy controls exposure to internet interest rate risk, equity market volatility, currency risk, VR limits, test thresholds. Concentration risk policy avoids excessive exposure to single user sector, industry, geography. Derivatives and hedging policy defines purpose of derivatives, hedging only, not speculations, approved instruments, risk limits, reporting requirements. Compliance and regulatory policy ensures adherence to regulatory norms, IRDA, RBI, and SEBI, investment ceiling, and solvency requirements. Role of ERM in investment risk management that integrates investment risk with other enterprise risk, link investment decisions to capital adequacy, use key risk indicators, report to board and senior management, support strategic decision making. Benefits of investment risk management framework policies are capital protection, stable returns, reduced volatility, improved governance, better compliance, transparency in decisions, enhanced investor confidence, long-term sustainability. Challenges in implementations, market unpredictability, data limitations, model risk, human judgment errors, cost of implementation, regulatory complexity. Illustrative examples, an insurance company set maximum 10% exposure to equity, minimum credit rating of AA, maintains 15% liquid assets, uses derivatives only for hedging, conducts quarterly stress tests. This ensures safety, liquidity, and controlled risk taking. An effective investment risk management framework and well-defined policies are essential for safeguarding funds, ensuring liquidity, and achieving optimal risk adjustment returns by integrating governance, risk measurement tools, limits, and monitoring system. Organizations can manage investment risk in a disciplined and systematic manner. ERM further strengthens this framework by aligning investment risk with corporate strategy and capital management. And thank you. Today's session is over. Our fourth unit is completed.